All right, let's dive right in. Today, we're putting UniFirst Corporation, ticker symbol UNF, under the microscope. We're doing what I absolutely love to do, taking a wall of raw financial metrics and translating it into a clear, actionable narrative. By the end of this explainer, you're going to see exactly why peeling back the shiny exterior of a stock's price action is absolutely crucial to finding out what's really going on with the underlying business.
Here's the roadmap for our breakdown today. We'll start with the market rally, then look at their zero debt and steady dividends. From there, we'll cover their modest margins and slowing growth, look at the high price tag, and finally, weigh the intrinsic value against reality.
Section 1. The UniFirst Market Rally. Okay, so if you've even glanced at a stock chart for UniFirst lately, you've seen this gleaming, shiny exterior that just catches your eye. And honestly, it's easy to see why. Long-term holders have been massively rewarded here. We're talking a 10-year return of over 145% and a 15-year return of nearly 444%. But if you zoom out to 20 years,
807%. Seriously, let that sheer compounding magic sink in for a second. Over 2 decades, UniFirst has been an absolute wealth-generating machine, returning over 8 times in investors' initial capital. That is exactly the kind of track record that builds a fiercely loyal shareholder base.
and the crazy thing is, the momentum hasn't stopped. Just this year alone, the stock is up over 35%, trading right around $261 a share. Now, if you're only looking at the surface, you'd probably think, wow, this is a guaranteed winner. It's invincible. But we don't just look at the surface, right? Let's peel back a layer and see what the underlying fundamentals actually look like.
Section 2. Zero debt and steady dividends.
So, is the actual business as robust as the stock chart? Well, structurally speaking, the skeleton here is incredibly strong. Take a look at this balance sheet. Their debt-to-equity ratio is exactly 0. 0. They owe absolutely nothing to long-term creditors. In an environment where high interest rates are just crushing leveraged companies, UniFirst is practically immune. Combine that with a current ratio of 3.11 and a quick ratio of 2.60, and they're sitting on massive liquidity. They've got more than 3 times the assets they need to cover short-term liabilities. And you know what a rock-solid, zero-debt balance sheet lets a company do? It lets them fund a super reliable dividend. UniFirst is sitting on an 8-year streak of consecutive yearly dividend increases. Looking ahead, their next ex-dividend date is June 5, 2026, with the payout hitting accounts on June 26th. This is the definition of a sleep-well-at-night balance sheet.
Section 3. Modest margins and slowing growth.
Now, we've admired the sturdy skeleton, but let's pop the hood and check the engine, because this is where things get really interesting, and frankly, a bit of a stark contrast to that surging stock price. Despite the stock being up 35% year-to-date, look at the actual trailing 12-month compound annual growth rates. Revenue is basically flat, barely squeezing out less than a 1% increase. Net income? Down almost 10%. Earnings per share is down 14%. And free cash flow is just shrinking rapidly, down over 44% over the trailing 12 months.
When we check in on profitability, we see a business that's definitely healthy, but it's running on a pretty modest engine. Their return on invested capital is just 5.61%, and their net profit margin is a very slim 5.92%. So yes, they are profitable, but they definitely aren't extracting massive efficiency or pricing power from their capital.
Which brings us to the big question. We've got a zero-debt company with a great history, but growth is stalling out and cash flow is shrinking. So, with slowing growth and single-digit margins, is that $261 price tag actually justified?
Section 4. The high price tag. Let's look at valuation, because what the market is demanding you pay for these shrinking earnings is wild. Across the board, UniFirst is trading way above its own recent historical averages. The PE ratio right now is over 35, which is a massive premium over its 3-year average of about 26. Price to sales and price to book are both elevated too, but check out that bottom row. The price to free cash flow ratio is sitting at an astonishing 51.77. That's nearly double its 3-year average. You are paying a massive premium for cash flow that, as we just saw, is dropping.
And to look at that from a yield perspective, here you go. The current free cash flow yield is just 2.03%, compared to its 3-year average of 3.06%. Bottom line, investors today are getting way less cash flow bang for their buck than they were just a few years ago. You're basically paying top dollar for an engine that's slowing down.
Section 5. Intrinsic value versus reality. This is the climax of our explainer, where we put the market's unbridled enthusiasm up against the cold, hard math of a discounted cash flow model. Just to quickly frame this, intrinsic value is the calculated true worth of the stock based on its future cash flows, and your margin of safety is the discount between the current price and that true worth. It's your buffer if things go wrong.
And the contrast here is honestly jarring. The stock is currently trading right around $261. But based on the actual cash flows this business produces, the discounted cash flow fair value price is exactly $125.08. Think about that. The mathematical fair value of this company is literally less than half of what the market is pricing it at right now.
Which means your margin of safety is negative 108.74%. Let that number land for a second. There is absolutely zero room for error at this valuation. In fact, the math is screaming that you're overpaying by a massive margin. If this company hits a speed bump, there is virtually no fundamental floor to catch the stock price until it falls significantly. And that brings us to the core takeaway of this whole analysis. A great zero-debt business is not always a great stock to buy at any price. UniFirst has an incredible legacy, and that flawless balance sheet is a marvel. But a sturdy skeleton just doesn't justify infinite valuation multiples when the underlying growth engine is sputtering.
So I'll leave you with this to ponder. Is paying a 35 PE ratio for a company with negative free cash flow growth a risk you're willing to take in your portfolio? It really highlights the vital difference between finding a safe company and finding a safe investment price. Thanks for joining me on this explainer, and keep bringing that focused curiosity to your learning.